of a normal apartment in Jakarta 30 years back, and now how much it is? It is almost thousands of 10,000% increase. Same, consider it after 30 years, what will be the rate? So after 30 years, the inflation will become more high. It's too much high than you are looking at now. So to maintain a regular life, a stable life, you need investment and a good return. If you're thinking I can maintain a good life now by spending 1,000 USD per month, but after 30 years, how much it would be required to maintain the same level of standard of life? It may need 5,000 USD or 10,000 USD, depends on the inflation. So the concept, we should be very clear that we need investment. It's not the issue that how much money I have, but how much money I need. So I need to go for the investment to fulfill the requirements of inflations and zakat and fulfill my lifetime goal. Okay. If you decide that I need investment, very fine, then where can I invest? I can invest in real estate. I can buy an apartment or asset or land, or I can buy the gold. I can invest in the gold, or I can set up my own business. So there are many ways to invest. But this lecture today, I talk about the issue of the investing in capital market. Why we invest in the capital market? So there are a few other markets already here, the financial markets, including the crypto market, cryptocurrency, or the forex market, exchange. But today we focus on the capital market because capital market is still widely accepted, whereas the crypto has lots of controversy and is not accepted yet. Many countries are it's not legally accepted in many ways. So look at the capital market. Why we invest in the capital market? What's the benefit of investing in capital market over the real estate or over the setting own business or saving in banks or investing in the gold? The capital market return is very high. How much high it is? Why capital market return is very high? So if you look at economy, the most of the wealth of a nation is in the capital market. The capital market represents the wealth of a country. Most of the big companies, big business, those who are in the public listed, they go in the capital market. So in the capital market, they generate the fund. The corporation generate their fund and they give the dividend to the owners of the companies. So if I say that you have trillions of dollars like that rich guy, what would you do? Which business you will buy? Which company you will buy? What do you like? So you can say few big banks from your country, you can say few big companies, few big industry name. I like this company, this industry, I can buy this company. If I have the money, I'll buy the whole company. Why you buy the whole company? Because this is a big company, this company has good reputation, it has enough money, it is very strong, and it has lots of activities, lots of branches all over the country, and it do huge activities and it give lots of profit. Very usual, very basic concept. If I ask you which one you want to buy, you can say, okay, I want to buy the Shell, or I want to buy suppose the KFC or Apple. Okay, so why you buy it? Because it has reputation and it gives lots of money, it has high income. Okay, very good. So all now in the stock market, you have the scope of buying all of them, not a particular single company. You can buy all of the company. That's the benefit of the stock market. You can go and you buy all of the companies. And even you have no need for $1 trillion. If you have only $10, you can buy the same as you want to invest as $1 trillion. You can get the same portions of that company as much as your capital has. So you get the idea that if you have $1 trillion, you can buy this company. If you have $10, you also can buy this company, but as percentage of your amount of investment. So you will get the return same as the $1 trillion investment return. So here the scope of getting high return from many companies, and therefore you can diversify it. Okay, if you really buy the Coca-Cola company, you cannot sell it next day. If you are the owner of the Apple company, you set up a business like the Microsoft, you cannot sell it next day. If your business making loss, you cannot exit from here very easily. But if you buy the stock from the stock market, rather than set up in your own company like that, you can easily diversify your investment. You can buy hundreds of companies with very less investment. You have lots of choice. You can enter and exit very easily. If you don't like this company, just sell the share, no problem, very easy and very quick. And you can invest any amount, no need for a huge investment. And you also can get the credit loan very easily. If you invest in the stock market, you get the credit, easy credit. And your liability is limited here, only related to your investment. That liability will not come at your home, your personal level. And if you invest some stable company, your income is stable. You can predict that income will come regularly, same basis. Suppose if you invest in a utilities company like the water supply company or electricity company, then they have the income and you predict the income is all constant and you will get constant dividend every year. And there are also tax benefits. If you invest there, if you take the margin credit, you get the tax benefits. And you have no need to work full time. You have no need to run the whole business. You have no need to involve in the management, no need to take all the pressure of the business. You just get the return as like as all other investor. That's why capital market is easy for investment, and it has lots of benefits. Especially anyone can, small guy or big guy, everyone can go there and make money. But the point is, many people don't make money. Making money is not easy. Making money needs your brain, your effort. So we are coming on this issue. So this now we understand why we should go in the stock market. And one thing in stock market, the benefit of stock market is the lower risks. You can diversify your risks. You can reduce the risks. Risks is very, very important. This is very important because we are not the risk taker. People, human by nature, are not the risk taker. We don't like risks. We invest money to get more. But what is the risk here? Risk here is we can lose our capital, not the gain. One thing is, if we put money in the bank, we may earn very little, but there is no chance to lose the capital. My capital will be intact. But if you go in the market, you have chance to lose your capital. So you're coming on this issue, the risks. And in the stock market, you have very good scope to diversify your risks, reduce your risks in a given level of higher return, which is highly volatile in the currency market or forex market and also crypto market. You see the price of the Bitcoin, and it's highly volatile, and it's most of the Bitcoin, most of the cryptos are not yet accepted in the society, and it's you cannot convert it into cash, or you cannot use it regular basis. So still we have a scope to invest, to get better return from our investment through capital market. So this is a quite details on the stock market. So I will pass it very quickly. So capital market has two views. One view is from investor perspectives. Suppose you are an investor, you want to invest in the market. And another view is from the company perspective, business perspective, those who run the business. So their perspective of capital market is important if you are a student enrolling the course as a student. But your perspective as an investor is important if you want to invest. So here I try to mix in both cases. So why we tell it the capital market or a stock market or share market, different name. So capital, company business needs two types of capitals, or they generate capitals in two ways. One is equity and another one is debt. They can borrow money. They can borrow from bank, borrow from anybody, borrow from the people. So that's the debt market. Another one is that take the shareholder or a stockholder or another partner in the business. So they increase the stock size, increase the number of shares, take more partner in the business. That is equity. That's the stock. So business can grow in both ways. When they need more capital, they can borrow money, or they can take the partner in their business. Okay, both has the merits and demerits. And the stock market or the capital market give the scope to generate fund in both ways. That's why it's called the capital market. Capital market includes the equity and the bond market. And there are also other issues are here will come in. So in general perspective, stock exchange is also enlisted as a company, and that give the facilities for investor to invest in the companies, and thus give the facility to business to generate fund. So through this platform, both supply of the fund and the receiver and the borrower of the fund can match their requirement in the market. So one is the equity market. Equity market is when the company goes for stock. The company issue a stock or issue a partner, take a partner to generate fund. So there are a few terminologies are here. One is called the primary market, and as a secondary market. Primary market is actually the first time when company issue the stock is called the IPO, initial public offering, or primary market. And business also can generate fund when they issue equity or a stock in two ways. One is public offering, they offer to the public. Another one is private placement. They sell the large volume of stock to some specific group of people with some different requirements, suppose the list price or a period, controlling period. But when they go for the market for the first time, that's called the IPO. The company issue a new fresh share. That share never issued before. Maybe a new company come first time in the market and issue a share, or an old company issue some new share. That's called the IPO. So IPO money goes directly to the company. And then the company generate capital through IPO, issuing IPO, and reinvest it or invest in extend their business. Okay. So why business need to go in the public? Business go for public because there are lots of issues. The small business go for public because it gives lots of benefits. One of the benefits is you want to extend your business. Suppose you set up a small business, now over the time it's grow, and then you need more capital. You need huge capital, and that's capital you cannot borrow from bank. That is really very expensive. Or you cannot just take partner from your channels or your known people, rather than you take money from the market. If you take money from the mass people, you can generate huge income, huge capital. And that's also have other benefits. Suppose the reputation of the company will grow and the company will become lifelong, is continue, and your employee will also get some sort of assurance that their career path will continue in this company. Suppose those who are a student, what is your plan? Your plan is after finish your graduation, you want to join in a multinational corporations or in a local corporation. That's a company. All over the business you see, that's are the companies. That's why most of the books where we teaches are for preparing our student for serving the companies. So the overall, when the business go in the company, they have lots of scopes. So business ultimately try to go for the public listed company. And this is the IPO when they first time issue the stock. And after they issue the stock, the first time, people already has the stock. Now people can buy and sell the stock among themselves. So this buying and selling has no link with the company, as the money doesn't go to the company. Company already got the fund, and now the stock is available to the people, and people do the transaction in the market. They buy and sell it. That is the secondary market. In the stock exchange, that give the facility to do the regular transactions of this stock. So you can buy and sell the stock. That is the secondary market. And the stock exchange is an organized body. It has a monitoring committee. It controls the market. It has rules, regulation, and its main purpose is to ensure the safety of the investor. So investors will not lose their money. So in the stock exchange, there are a few terminology. One is called the organized market, the main market. Another one is the over-the-counter. Those stocks are regularly traded and the depth is high. People buy and sell. There are lots of buyer and seller. These are called the organized exchange, organized market. And the other one is the over-the-counter market. Over-the-counter market is when some stock is not traded that much. People don't buy and sell this regularly. not enough buy and seller available.
Ya.
So this is
Boleh. Saya aku udah ngecek Tokopedia, Mbak. Tokonya cek.
they transfer the stock in the over-the-counter market. In the organized exchange or the main market, the stock, you can monitor the stock price continuously. It's very transparent. Everyone can see it. But over-the-counter market is run through the dealers. So you cannot, or anyone cannot get the price easily. You need to ask the dealer, and the dealer actually know the market. So there are lots of lackings in transparency. Okay. And I saw due to the COVID, when the many stocks are not traded, they shift to the over-the-counter market. So in the equity market instrument, we say it is stock or share. Share is actually a small amount of ownership of the business. If you buy a share or a stock of a company, meaning you are an owner of that company. Same like those who are the big guy, they have the huge investment, huge stock. They are also owner. So your return will be same as their return. Suppose if you invest in Amazon, if you buy a stock of Amazon, you get the same amount of return as that rich guy. How much amount he get as his in return from business, you also get the same return without doing any activities in the business. Just relax and you get the same return. So there are two types of stock in the stock market or in the equity. Company issue ordinary share or common stock. Another one is the preferred stock. The common stock has some benefits and also some problem. Both have the pros and cons. From the perspective of corporations, those who issue the stock, and from the perspective of investors. So investors' perspective and the corporation's perspective are different, just opposite. Okay. So if investor get better, meaning the corporation is in the negative side. When the investor is positive side, then meaning the corporation is the negative side. So they are just the opposite. So in case of the common stock or ordinary stock, company need to share their profit and loss unlimited. So if you buy a ordinary share, that you are the real investor of the company, or you are the real owner of the company. You have the right to give the vote, to select the managing committee, and you can also elect for yourself, and you has the scope for unlimited profit, and also your loss is also very high until your total investment. So why company, and another cases is the preferred stock. Preferred stock where you have the assurance of a fixed income, as a bond, as a debt holder, your assurance has a get of fixed income. Suppose you will get 10%. So if the company earn lots of loss, still you get 10%. You will not earn more. And your losses also like that. You lost very low. Suppose your loss is 5% maximum. So if company make loss, you can make loss 5%. So it's not whole amount. And you cannot give any vote. Your right is limited. You are not actually the owner, the regular owner. So these types of stock or equity is a mechanism for the corporation to save themselves from legal issues. So company can generate fund two ways. One is equity, another is the bond or debt. So in case of debt, company has also facilities. The main facility is the tax benefit. If company take the debt, they can reduce it from their tax amount. Interest amount, if you look at the income statement after EBITDA minus interest expense, then you get EBIT. So earning before interest and tax, and then you deduct the interest, then you calculate the tax. The corporations, if they borrow money or if they issue debt, issue bond, they has a huge tax benefit through interest payment. So if the company want to grow more, if the shareholders want to earn more profit, they actually go for bond. Okay. So you know the finance theory, high risk, high return. If the company get high return when they issue bond, the risk also very high. What is the risk for here? The company is a lifelong, they never die. The law give the facility company as a human, they will continue forever, except if they are not able to fulfill their due. If company fail to pay their debt, company will finish. The company will settle only one condition, if they are not able to pay their debt. So that's why the management is very cautious about taking the debt, because if they are not able to pay the debt, this company will close. So high risk, high return. You see, if they take the debt, they get huge return from the tax benefit, and the corporation tax rate is very high, around 40%. It varies among the countries, but close to 40% everywhere. And some countries very high, like Germany is 80%. So the corporation's tax rate is very high. So when they can take the bond, issue the bond, they can get huge tax exemption. When they get tax exemption, what happened? Your per capita income on investment will become high. Return on investment for the shareholders will become very high. If company take 100% equity, then everyone get equal same amount. They distribute the capital, they distribute the dividend from the income, suppose the 10 USD. But when they have the benefit from interest, so they get the tax benefit. So per person, investor will get more dividend because they have marginal benefit from the tax due to interest, which is in cases normally if one stock give the 10 USD dividend, same if they take 50% or 40% or some portion of the debt and they get the tax exemption due to interest rate payment, their dividend will be more. Suppose instead of 10 it will be 11. So the per capita investment return will be high. Return on investment, return on equity, all the ratios will be high. So that's why company looks to issue debt. But the problem is debt is highly risky, very, very risky. So everyone has a risk tolerance level. So biologically, if the company increases more and more and more debt, their return will be more and more, per capita return will be more and more. But in real life, company don't take much debt because it's very risky. They will die. So they try to find out an alternative. So the alternative is common stock. You need money, so you need capital. You can generate capital through two ways. One is equity, another one is debt. So somehow we don't like to expend debt too much. Then alternative is we should take a partner. We should share our profit with a partner. So whenever I take a partner in my business, he will take the profit same as me. So what the point? I take a partner and share the profit with him. So people don't want to share the full amount of profit as their own business. So they try to find out a mechanism, issue a preferred stock. So the preferred stock, the return is like as the debt holder. So they get better return than the bond, but they are the shareholder. So shareholder cannot sue against the company because they are the owner. They are not the debt holder, so they cannot sue against the company. And the existing shareholder also no need to share their regular income. They give a less amount of income. So the existing shareholders can save themselves due to legally unable to sue against the company and also pay less dividend. So the new shareholder, he get the assurance that he will get a fixed amount percentage and he will be shareholder, but he cannot sue against the company and not a regular shareholder. And his income will not unlimited. That is the preferred stock. So preferred stock is by nature is mix of both bond and common stock. By legal right, they are like the stockholders, common stock, but by return they get like the bond stockholders. So this is from the company perspective, issuer perspective, and the investor's perspective. Why you go for the preferred stock? Because preferred stock has a guarantee of income. You have a guarantee of certain percentage of income constantly. So, and this income is little bit higher than the bond, because bond give you less risk, bond give you the right to sue against the company. So you remember one thing, for all cases, risk and return go parallelly. Whenever your risk is low, your return will be low. So bond is less risky. When company settle, close, the bondholder, debt holder get the highest priority. So first they will clear. Suppose the company has 100,000 total asset. After they close, they sell everything. Now the total asset comes 20,000. They sell everything and they get 20,000. The first priority will be get the bondholder. So if the bondholder get 20,000, suppose they have the debt 20,000, everything taken by the bondholder. There will be nothing left for the preferred stockholder and common stockholders. So preferred stockholders has less security, meaning little bit higher risky than the bondholder. So they expect little bit higher return than the bondholder, and they get it. The return of the preferred stock is little bit more than the bond. And at the same time, their risk is also less than the common stockholder, because common stockholders has unlimited risks, or the risk is limited up to their total investment, but the preferred stockholders will not carry that much risk. So in both cases, from the investor's perspective and from the company's perspective, you always need to think the risk and return. However, you take the high risk, you expect high return. And then come the few other issues that's called in the stock market. You find them. There's the warrant or bonus issues or right issues. So you will get it later on whenever you search in the online, because we don't have much time to discuss everything. And the other issue is the stock market indices. In the stock market, there are lots of indexes created by the stock exchange or independent body, or you can create your own index too. So indexing means it actually make a basket of relevant stock to see the performance, how the market is moving. Okay, so this is the IDX for Indonesian market. Indonesia IDX composite is the all the stocks of the Indonesian Stock Exchange, Jakarta Stock Exchange. So look what happened now. This is the yesterday index. If you look the index, then you can understand what happened in the market. If you look just after 2020, when the COVID just started from March 2020, you see the market crash. Market crash from 6,500 to 4,200 like this. 2,000 unit market crash. So, and then market recovered. And now the market is almost 7,000, which is the highest from last 5 years, even last 10 years. This is the maximum forever. The Indonesian market is now very crazy forever. It's the peak forever. So if you understand the risk return, if you understand the market, you can see this is very risky situation now for an investor. The market is all-time high and is overcome the previous all record. So if you want to enter market, this is very, very bad time. Or if you enter the market just after the COVID, you see now what happened. Your income would be almost 80% up. So this is the index. If you see the index, then you get the scenario of what is actually going on in the market. Okay. So market created lots of indexes. So you get the idea just looking at the index. So this is the total index. There are also index based on the Islamic stock, or index based on the top 30 or top 100, or based on the palm oil companies or the petroleum sector or manufacturing sector. There are lots of index. So if you have interest on anything, you just focus on that index, you get your idea. So who are the participants in the equity market? There are lots of agents, or we can say stakeholders. So investors, and also the broker house, those where you can open an account to do the business, and investment banks, those who generate fund or give the guideline for the companies to generate fund, and the corporations, governments, foreigners, foreign institutions, and other financial institutions, and even individuals or very rich guys, those who have lots of money, or different fund holder, pension fund, or other cooperatives, those have the money. Everyone can invest in the stock market. And Securities Commission is the authority of the stock exchange. They control market, they check everything, and this is licensed under any stock exchange act. For every country has different act, and this is a different statutory body. It's not controlled by governments or not controlled by fully private, it's mixed. So their main responsibility is enlisting new companies, checking the companies, monitoring the companies' financial conditions, regular update the investors, and the main issue is they want to secure the investors. So investor, there are lots of things can happen. There are lots of syndicate, people can take your money. and the Securities Exchange Commissions take the responsibility to monitor and protect your investment. Then look at the debt market. There are lots of bonds company can issue. Also, bond can issue by the government. Government need the bond, so government also issues the bond. And there's also Islamic bonds that's called the Sukuk. And there are some terminology differences, the infrastructure and their conditions and money, and the contract is different. Okay, so bond market is also important for long-term investment because stockholders sometimes already mentioned why people don't want to take more shareholders, more partner in their business, and companies also want more debt to get the tax benefits. So they want fixed income investment or bond. They want to take the debt. Another issue is that in the debt you will get a fixed income. Many fund managers or the oldest people or people want a stable income, so they want assurity and stability in their income. In that cases they go for the bond market or debt market. In the debt market the risk is very low and income is stable. You will have a constant income almost whole the life of the asset, and there is a assurity. You can also diversify your portfolio with low risk asset. So bond is considered a very low risk asset because here one thing is legally they have the good right. Another one is their income is stable. So this is considered the low risk asset. The government also issue the bond. When government need the fund, government issues the bond, that's called the treasury bill or treasury notes. Treasury bill is the short term working capital. Government needs 3 months, 6 months, 9 months, or 1 year bill. Or it can be the Shariah compliant Islamic treasury bill or conventional. And as the long term notes, long-term notes is suppose 2 years to 20 years, 30 years, or some cases 3 years to 30 years, 20 years, like this. Except the governments, the other quasi-government and institutions like governments and private mix, they also issue the bond. Municipal also issue the bond. Suppose you need to develop a highway, also you can issue a bond for long-term capital generations. And international developments agencies also issue bond, and public listed companies issue the bond. So the investors of the bond markets are especially those who want to reduce the risk in their portfolio and ensure a constant income, like the provident fund, the pension fund or unit trust, insurance companies or asset management companies, also the commercial banks. There are lots of types of corporate bonds, so it's almost unlimited. Every corporation can create their own style of bonds because the bonds requirement conditions is up to the company. So how they like, they can create the conditions. So the main point is the company want to get enough capital through the bond. So they try to make it more attractive to the investor. So they add different features with the bond, so people buy their bond. And bond is long term also, 20, 30 years, 10, 20, 30 is very long term. So investors also want some assurance, some guarantee, some benefit, because in case of bond, the rate, profit rate or interest rate is written on the bond. Suppose this bond is for 30 years, the interest rate is 10%. The bond face value is 1,000. So we don't know what will be case of the interest rate after 20 years, after 10 years. That cases, both the corporation, those who issue the bond, and those the investors also want to get some idea or some guarantee to save themselves. That's why nowadays most of the bond also bond is callable bond. That means if the interest rate decrease very high, they can call their bond anytime. Like the zero coupon. So in this types of bond, there will be no coupon, no interest rate or no rate mentioned, but the company sell it with discount. Suppose if you buy a bond suppose $100, but the face value is $1,000. So after, it is a lifetime of 30 years. After 30 years, the company will pay you $1,000. But now company collect $100. Company is selling the bond at $100 only. So over the time 30 years, the price automatically adjusted up to the $1,000. So they have no need to give any coupon. They don't give any coupon rate, but they sell it discount, so it automatically increases over the time. And there are also some other options. Suppose they can set the floaters. So in case of floaters, the interest rate or coupon rate of the bond attached with an market interest rate or any index. So when the index or interest rate in the market increase or decrease, the coupon rate also increase or decrease. The coupon is the interest rate or profit rate given for this bond. And market interest rate is different. Suppose market interest rate is now 2%, but bond give you 10%, 5%, what is given on the bond face, what is mentioned on the bond document, on the face of the bond. So that is the coupon rate. And some securities are backed by asset, or some securities is just the overall. And this Islamic bond is also different. We'll come later. The bond also pricing by different bond. The issue of the bond is for 20-30 years, and the income of the bond is fixed. Coupon rate is fixed. But in case of a stock also issue for lifetime, not 30-20 years, is for the lifetime of the company. But the return of the stock is not fixed. If the company do good, the return will be high. But in case of bond company, what the company do, good or bad, the coupon rate is fixed. So once the company issue the bond, that is already detached from the company performance. So there will be some other agency. There are some other agency who monitor and give the rating of the bond. So they check the company performance and then give the rating of the bond. They are different agency, like Standard and Poor's. They're very international agencies, Moody's. So they check and give the rating. Based on the ratings, you can understand that the company, how much is doing, what is their performance. And there are also national rating agency. So bonds are rated as AAA, AAA, triple B. So it is always suggested to invest above triple B because BB and less is very risky bond. So there are other instruments. There are other instruments like the derivatives market. In the stock exchange, you will get the other markets beyond the bond and equity. Derivatives market, there's the future market or option market. That's not linked with the exactly same product, but different product. Suppose the future markets of palm oil, future markets of other commodities like sugar or other regularly highly used commodities market. So derivatives is the forecasting market, the future market. You buy now and sell later, or you buy it for future time. And the other is the unit trust. Unit trust is not for any individual company or any individual stock. There's also mutual fund or ETF. They're almost same. So there is a manager, fund manager, who manage a pool of fund. They collect lots of money from people and invest the money, and they have no production, no stock, so they say it as a unit. So based on the total unit of investment and total value of the portfolio, calculate the unit net asset per value. So NAV, net asset value per unit. So if you buy one unit, suppose 1,000 now, and over the time, the overall asset increase, so the unit value is 1,050. So you have 50 extra. And here it is little bit safe because the investor, the management is the professional manager, and they manage everything. They diversify the portfolio and give you a normal return or better return with less risk. And then if you come to the Islamic capital market also has the same of conventional capital market. They have the equity and bond, that's called the Sukuk. In the Islamic capital market, there is a Shariah board. The Shariah board check the requirement based on the Islamic principle that the company stock is Sharia compliant or not. So those who are the Muslim, they definitely go for the Islamic stock market, and those who are not Muslim, they also can go in the Islamic stock market. Islamic market is open to everybody. Those who are not Muslim, they go here because the risk and return. They want to diversify their portfolio. Here the risk is highly monitored than the conventional market, because Sharia, when the Sharia board monitor everything, they check the condition that Sharia gives. Sharia mentions is welfare. Sharia mention avoid the excessive risk, garar. So the Sharia board check all of these issues, and there are other issues. So any investors can get better when they come in the stock market, Islamic stock market. So by product, if the product is not Sharia compliant, is not halal product, they automatically go out from the index. But then those who get initially approved, the product itself is good, the product is halal, what the business they're doing, this is halal business, then they go further check down. In the further checking, the Sharia committees check two issues. One is quantitative and another qualitative issue. In the quantitative method, suppose this is the Malaysian stock market, they set up benchmark, 5% benchmark and 20% benchmark. So 5% benchmark, suppose the business is halal, but their income, some part of their income come from the non-halal sources. Because it's very difficult to ensure all of your product, all of your income is halal. Suppose your business is halal business, everything fine, but your account is in conventional bank. So you have some income, interest income from conventional bank. So that's actually not halal, but overall business is halal. Earning interest from bank is not your business. Suppose you are doing some business, but you have one account in non-halal purpose. So in non-halal bank, so you get some interest income. So overall, those products are without any controversy, the product is haram. The Sharia Council allow 5% of the income from that sources is okay in the portfolio. But some other cases, it's mentioned 20%. Suppose your hotel or your resource operation, hotel business is halal business, but in the hotel you need to serve the liquor. That part is not halal, so you need to check how much income of the overall hotel business come from that particular non-halal sources. Or you have a airlines business. In the airlines is halal business, but in the airlines you need to serve liquor. So you need to check how much percentage of income come from that sources. So Sharia board give some benchmark to make it feasible to run the business in the Islamic market. And then is look the other issues. Suppose the ratio, few ratio, one is the cash over total asset. If the business hold too much cash, like the banks, so it's almost a cash business. So in Islam, money, you cannot money convert into other money.